All right, let's jump right into this explainer. Today, we're putting Penguin Solutions, a really fascinating player in the AI infrastructure space, through the absolute ultimate valuation stress test. We hear the hype literally every single day, right? AI is taking over the world, inference workloads are absolutely exploding, and the hardware required to run all of this stuff, well, it's basically the modern gold rush. But listen, as investors, we can't just buy a good story, we have to buy the numbers. So today, we are taking Penguin Solutions, ticker PENG, and running its financials through a gauntlet of legendary investing frameworks. We need to see if the massive hype actually matches the math. And this right here perfectly illustrates the tension we're going to be exploring today. We really have to separate the massive, forward-looking AI narrative from the cold, hard financial reality. On the left side, you've got this incredible story. Penguin is aggressively pivoting to enterprise agentic AI workflows. They're seeing a massive 63% year-over-year surge in their integrated memory business, and they're fully capitalizing on the memory-bound nature of AI inference. Sounds amazing, right? But then, on the right side, you've got the financial reality. A stock sitting at $58.52, a pretty tricky transition period as they pull away from hyperscaler concentration, and legacy revenues that are actually dropping. To crack the code on this valuation, here is our roadmap for today. 1. Snapshot and the Buffett lens. 2. The Peter Lynch lens. 3. The Ben Graham lens. 4. A DCF valuation model. 5. Comparable valuation models. And finally, 6. Our synthesis and final verdict.
Okay, moving to section 1, snapshot and the Buffett lens, where we'll apply the Oracle of Omaha's qualitative criteria to PNG. So, what exactly does Warren Buffett care about? Well, he looks for a strong economic moat, honest management, a solid return on equity, and a manageable debt load. Taking a look at the snapshot, PENG is trading around $58.52 with a $2.97 billion market cap. First question, do they have a moat? Actually, yes. Penguin operates at this highly specialized intersection of AI infrastructure and memory. Specifically, they're building CXL memory architectures for latency-sensitive AI inference. Basically, they help process giant mountains of data at lightning speed. That is a real, tangible, competitive advantage. Management is fresh but looks highly capable. Kosh Sheikh is the new CEO, and Ian Collet, an Amazon Web Services veteran, just joined as Chief Product Officer. Debt is totally manageable at a 0.83 debt-to-equity ratio. But here's a slight hiccup. Their return on equity is 9.59%. That might give Buffett some pause, considering he usually demands 15% or higher.
Now, what's really interesting here is this hard figure, $99.1 million in free cash flow. We're using this as our proxy for Buffett's beloved owner earnings. This is the actual, literal cash the business generated for its owners over the trailing 12 months, after all capital expenditures. Buffett absolutely loves businesses that spit out cold, hard cash. But, and it's a big but, even with solid cash generation, Buffett always demands a wide margin of safety on the purchase price. Given the current valuation metrics, he would probably demand a 50% discount to fair value before he'd even blink at it, which puts his target buy price somewhere down in the $15 to $20 range.
Let's move along to section 2, the Peter Lynch lens. We're going to categorize the company and hunt for hidden gems. Peter Lynch, the absolute legend who managed the Magellan Fund, loved to categorize companies so he could understand their underlying story. He'd likely look at Ping as a hybrid. On one hand, it's a fast grower in its booming memory business. But on the other, it's a classic turnaround as it winds down its legacy divisions to focus purely on enterprise AI. Think about it. Their integrated memory segment just jumped 63% year-over-year thanks to insatiable AI demand. But at the exact same time, their legacy advanced computing business cratered by 42% year-over-year. They are purposefully moving away from low-margin hyperscaler hardware to focus on more profitable enterprise clients. So yeah, it's a messy transition. But Lynch often viewed messy transitions as a golden opportunity, if the underlying growth engine was strong enough.
Now, the absolute crucial metric to watch here is the PEG ratio, which comes in at 1.29. Lynch actually pioneered the PEG ratio. That's the price-to-earnings multiple divided by the growth rate. He loves finding a PEG of 1.0 or lower, which basically screams that a stock is undervalued relative to how fast it's growing. Here, we take Ping's forward PE of 22.80 and divide it by the 3-year analyst EPS growth forecast of 17.60%. That gives us 1.29. So in Lynch's eyes, Ping is just a little overvalued relative to its projected growth. On the bright side, though, the balance sheet is rock solid with a current ratio of 2.10, meaning they can easily cover their short-term bills. But wait, check this out. This is a massive anomaly, and frankly, a huge red flag for Peter Lynch's philosophy. We're looking at a shocking 114.91% institutional ownership. Now, you might be wondering, how is it over 100%? Because of short selling, there's about a 20% short interest on PENG right now. Shares are borrowed and resold, which means multiple institutions are claiming ownership of the exact same shares. Lynch loved the ignored, boring companies that Wall Street hadn't even discovered yet. PENG is the exact opposite of that. Wall Street is already entirely crowded into this trade, making it a clear sell or avoid in the classic Lynch playbook.
All right, diving into Section 3, the Ben Graham lens. Time for some brutally conservative intrinsic value math.
Ben Graham, the father of value investing, honestly wouldn't care one bit about FANG's exciting AI narrative. He only cared about hard assets and earning stability today, period. So while FANG's size and current ratio passes test, things fall apart pretty quickly. Its sky-high trailing PE of 83.75 and a price-to-book of 7.59 cause it to fail his strict defensive checklist completely. I mean, Graham wanted a PE below 15 and a price-to-book below 1.5. He also demanded a strong dividend record, which FANG doesn't have. By Graham's defensive standards, this stock is way, way too speculative.
And this number right here brilliantly illustrates the severity of Graham's intrinsic value formula. If we take the square root of 22.5, multiply it by the trailing earnings per share of 70 cents, and then multiply that by the book value of $7.71, we get a brutal intrinsic value of exactly $11.02. Think about that for a second. At the current $58.52 price tag, there was literally zero margin of safety. For Graham, this is an immediate hard pass. The current stock price is entirely disconnected from the historical assets and actual earnings. Let's pivot to Section 4, the DCF valuation model. We're going to project future cash flows to find a fair value today.
Okay, let's step away from the historical gurus and project some hard numbers into the future with a discounted cash flow model. Here's how we build our base case DCF. Step 1, we start with that $99.1 million in free cash flow and grow it pretty aggressively at 17.60% for the next 5 years. Step 2, we apply a standard 2.5% terminal growth rate, basically assuming the company eventually just grows alongside the broader economy forever. But Step 3 is where things get really challenging. PENG's incredibly high weighted average cost of capital, or WACC, is sitting at 17.24%. Because the stock has a high volatility with a beta of almost 2.9, that WACC acts like gravity, severely punishing the present value of those future cash flows.
So when we run our sensitivity matrix, you can really see the impact. Even if we're generous with the terminal growth, that heavy 17.24% WACC anchors our base case DCF fair value down to around $18.50 per share. Even if we drop the WACC to 15.24% and boost terminal growth to 3%, we still struggle to break $22.80 a share. The math is undeniable here. Unless free cash flow growth vastly outpaces current analyst estimates of 17.6%, the DCF model is telling us the stock is significantly overvalued right now.
All right, Section 5, comparable valuation models. Let's see how PENG stacks up against market multiples. Now, to be fair, sometimes intrinsic value models punish high-growth tech stocks unfairly. So let's test PENG against the market using comparables. Looking at the multiples, the trailing PE is an astronomical 83.75, mostly because of their recent restructuring and transition costs. But the forward PE drops all the way down to a much more reasonable 22.80, and the enterprise value to EBITDA ratio sits at about 21.46. The takeaway here is crystal clear. The market is entirely pricing in a massive future AI earnings expansion. That $58 price tag isn't based on what Penguin did yesterday. It's based entirely on the assumption that their pivot to enterprise AI is going to be a total, flawless success tomorrow. Okay, we've reached Section 6, synthesis and final verdict. Time to blend the lenses for our final analysis. We have officially run the gauntlet. So what's the ultimate takeaway? Well, our summary table really lays it out. Across the board, from Graham's brutal $11 intrinsic value to our DCF's $18.50 base case, the math simply does not support the current price tag. Buffett would be sitting on his hands waiting for a 50% margin of safety. Lynch would totally avoid it because of the extreme institutional crowding and a PEG over 1. Literally, the only framework that even partially justifies buying in right now is looking at future comparable estimates. And again, that requires absolutely flawless execution on their end. So here is the crucial point. Penguin is a fascinating company. They have real AI momentum, deep industry partnerships, and really solid underlying cash flow. But the lack of any fundamental margin of safety makes it a highly speculative investment at these current levels. They're doing incredible work pivoting away from those hyperscalers toward high-margin enterprise AI, but the stock is priced for absolute perfection. If you're holding, you are betting entirely on a massive forward earnings explosion. But if you demand a fundamental margin of safety before you invest, this is a clear sell, or at the very least, a wait.
Penguin Solutions really proves that a great company at the absolute center of a revolutionary technological shift isn't always a great stock to buy at just any price. Which leaves us to ponder the ultimate investor's dilemma. At what price does the AI revolution actually become a value play? Thanks for joining me on this explainer today. Keep running the numbers, and I'll catch you next time.